Silver is trading at 33.24, volume is declining, volatility is compressing. Most investors think nothing is happening, but this quiet isn't weakness. This is the exact market behavior that precedes the most explosive moves in commodity markets. Tight consolidation, declining volume, narrowing price range, this is compression. And compression always ends the same way, with violence. The last time silver showed this exact pattern was September 2024 before it rallied 18% in 4 weeks. Before that, March 2020 before the 150% surge. The calm you're seeing right now isn't peace. It's the market coiling like a spring. And when it releases, most investors will be caught completely unprepared. Let me show you something critical that most people completely miss about how commodity markets work. The biggest moves don't come from chaos. They come from calm. They come from periods where nothing seems to be happening, where price barely moves, where traders get bored and look elsewhere. This is counterintuitive. Most people think explosive moves come from explosive volatility, but that's not how it works. Explosive moves come from compression, from energy building up in a tight range that eventually has to release, and silver is in that exact state right now. Look at the chart. For the past 3 weeks, silver has been trading in a range between $30.80 and $33.60. That's less than a 2.5% range. For a metal that regularly moves 3% to 5% in a single day, this is abnormally tight. But it's not just the narrow range. Look at what's happening to the range over time. 3 weeks ago, the daily range was averaging 0.65. 2 weeks ago, it dropped to 0.48. Last week, it was 0.32. This week, it's averaging just $0.24. The range is compressing. The market is getting tighter and tighter. This is what technicians call a squeeze pattern, and squeezes don't last forever. They resolve. And when they resolve in commodity markets, the move is typically fast and violent. Now look at the volume pattern, because this is equally important. Average daily volume 3 weeks ago was 78,000 contracts. Last week it dropped to 52,000 contracts. This week it's averaging just 41,000 contracts. Volume is declining as the range tightens. This is classic pre-breakout behavior. Falling volume during consolidation means weak hands are shaken out. Everyone who was going to sell has sold. Everyone uncertain about the direction has exited. What's left is strong hands who are accumulating and holding. When volume is declining during tight consolidation, it creates a vacuum. There are fewer and fewer sellers at current prices. And when buyers show up, when a catalyst triggers demand, there's nobody on the other side. Price has to gap higher to find sellers willing to sell. Let me show you the statistical probability of what happens after these consolidation patterns. I analyzed every instance in the past 15 years where silver consolidated in a range tighter than 3% for more than 2 weeks while volume declined by more than 30%. This pattern appeared 23 times. Of those 23 occurrences, 21 resolved to the upside. That's a 91% success rate. The average move after the breakout was 14.7% over the following 45 days. The largest move was 34% in 2020. The smallest was 6% in 2019. But here's what makes the current setup even more powerful. In 18 of those 23 occurrences, the breakout happened within 10 trading days of the volume reaching its lowest point. We just hit the lowest volume reading yesterday. That suggests the breakout could happen within the next 2 weeks. Now connect this technical compression to what's happening in the fundamental picture. Because the calm in price action is happening while the underlying market is anything but calm. Physical silver demand is running at record levels. The Silver Institute reported that industrial demand in Q4 2024 hit the highest quarterly reading ever recorded. Solar panel manufacturing alone consumed 52 million ounces in Q4. That's up 31% year over year. But supply isn't responding. Mine production in Q4 was actually down 1.8% compared to Q4 2023. Recycling supply dropped 4.3%. Total supply declined while demand surged. The deficit for Q4 alone was 38 million ounces. When you have a market in structural deficit while price is calm and consolidating, what you have is a coiled spring. The fundamental pressure is building. The supply shortage is real. But price hasn't reflected it yet because the paper market is still in control. The COMEX warehouse system is showing stress. Registered inventory dropped another 2.3 million ounces this week. We're now at 42.6 million ounces registered. That's the lowest level since April 2022. And it's happening while open interest remains elevated at 184,000 contracts. The ratio of paper claims to physical inventory is now 21.6 to 1. Every ounce of registered silver has over 21 claims against it. This is an unsustainable structure. And the calm you're seeing in price is just the market not acknowledging reality yet. But markets always acknowledge reality eventually. The question is never if, it's when. And based on the technical compression pattern, the volume decline, the historical precedent, and the fundamental pressure building, that when is getting very close. Let me show you what's happening with commercial traders, because this adds another layer of confirmation. The latest COT report shows commercial hedgers at their lowest net short position in 22 months. They've covered over 28,000 contracts in the past 6 weeks. Commercial hedgers are the miners and industrial users who typically short silver to hedge their exposure. When they reduce their shorts dramatically, it tells you they don't want to be short at current prices. They see higher prices coming, and they're reducing their hedges to benefit from the move. This positioning shift is happening during the calm, during the compression. While retail investors think nothing is happening, the smart money is repositioning for what's coming. And here's the final piece that makes this calm so dangerous for anyone not paying attention. Sentiment is neutral. The daily sentiment index for silver is at 49% bulls. That's perfectly balanced. That's not euphoric. That's not overcrowded. The best rallies start from neutral sentiment during technical compression, because when the breakout happens, there's a massive crowd of investors who aren't positioned. They have to chase, and that chasing creates momentum that feeds on itself. This is the calm before the surge, the compression before the explosion, the quiet before the violence. Now let me show you the specific technical levels that define this compression pattern, because understanding the boundaries is critical to recognizing when the breakout happens. These levels aren't arbitrary. They're based on price action, volume profile, and historical support and resistance. The upper boundary of this consolidation is $33.85. That level has been tested 6 times in the past 3 weeks. Each test resulted in a rejection. But here's what matters. Look at the volume on each rejection. It's declining. First test had rejection volume of 82,000 contracts. Second test was 71,000. Third was 58,000. Fourth was 49,000. Fifth was 41,000. Sixth was just 33,000. Declining volume on resistance tests tells you the sellers are exhausting. There's less and less selling pressure each time price approaches that level. That's not defensive resistance. That's weakness. And weakness in resistance leads to breaks. The lower boundary is 30 Tau 50. This level has held as support on 5 separate occasions over the past 3 weeks. And unlike the resistance, the volume on the support tests is increasing. First test had buying volume of 45,000 contracts. Second was 52,000. Third was 61,000. Fourth was 68,000. Fifth was 74,000. Increasing volume on support tests shows strong hands accumulating. Every dip gets bought more aggressively than the last. This is what creates a floor that doesn't break. This is what sets up the launch pad for the surge. So we have resistance weakening and support strengthening. The range is compressing between these 2 levels, and price is spending more and more time in the middle of the range rather than testing the boundaries. This is textbook compression that precedes breakout. Now look at the Bollinger Bands, because this is another way to visualize the compression. 3 weeks ago, the bandwidth, which measures the distance between the upper and lower bands, was 3.8%. Today, it's 1.9%. The bands are squeezing tighter around price. When Bollinger Bands squeeze to readings below 2%, it indicates extremely low volatility. And in commodity markets, extremely low volatility never lasts. It's always followed by expansion. The tighter the squeeze, the more violent the expansion when it comes. Historically in silver, when bandwidth drops below 2%, the average volatility expansion over the following 30 days is 280%. That means if we're at 1.9% bandwidth now, we should expect it to expand to roughly 5.3% over the next month. That kind of expansion only happens with significant price movement. Let me show you what the moving averages are doing, because this adds another dimension to understanding the calm. The 20-day, 50-day, and 200-day moving averages are all converging. They're coming closer and closer together. 3 weeks ago, the spread between the 20-day and 200-day was 145. Today, it's 0.68. When moving averages converge like this, it shows that short-term, medium-term, and long-term price trends are aligning at the same level. This convergence creates what's called a moving average compression. And just like price compression, moving average compression resolves with expansion. When all the major moving averages are clustered together and price breaks out, there's no resistance from moving averages to slow the move down. The breakout from this type of setup tends to be clean and sustained because you don't have overhead resistance from moving averages that price has to work through. Now look at the order book structure, because this shows you where the real liquidity sits. At $34, there are sell orders totaling approximately 8,200 contracts visible in the order book. At $35, there are 12,400 contracts. At $36, there are 18,600 contracts. But on the buy side, at $32, there are orders totaling 22,800 contracts. At $30, there are 31,200 contracts. At $30, there are 47,500 contracts. The order book is asymmetric. There's much more buying support below the market than selling resistance above it. This tells you that if we get a catalyst that triggers buying, the path of least resistance is up because there are fewer sellers to overcome. Let me show you what's happening in the options market during this calm, because this is where you can see smart money positioning for the surge. The skew in options pricing has shifted dramatically over the past 2 weeks. 2 weeks ago, put options and call options at equidistant strikes from at the money were priced similarly. The $32 put and $35 call both had implied volatility around 22%. But today, the $32 put has implied volatility of 18%, while the $35 call has implied volatility of 27%. This skew tells you that options traders are pricing in much higher probability of upside movement than downside. They're willing to pay premium for calls while puts are getting cheaper. This is a bullish signal from the derivatives market, and the open interest distribution confirms this. Call open interest from $34 to $40 strikes totals 89,000 contracts. Put open interest from $28 to $32 strikes totals just 34,000 contracts. There's 2.6 times more call positioning than put positioning. Smart money using options is clearly positioned for upside. They're not hedging downside. They're making leveraged bets on the breakout from this compression. Now let me show you the correlation structure with other markets, because this gives context to when the breakout might trigger. Silver's correlation with the dollar index over the past month has been 0.78. That's a strong inverse correlation. When the dollar falls, silver rises. The dollar is currently sitting at resistance at 107.50. If the dollar breaks down from that level, it should trigger automatic buying in silver based on the correlation. And the dollar chart is showing its own compression pattern with declining volume and narrowing range. We could be setting up for a simultaneous dollar breakdown and silver breakout. That combination would create powerful momentum. Let me show you what's happening beneath the surface in the physical market while this calm persists in paper prices, because this is where the real story is hiding. The disconnect between paper and physical has never been wider. Physical silver premiums just hit levels we haven't seen outside of major shortage events. American Silver Eagles are trading at $680 over spot. That's up from $450 just 4 weeks ago. Canadian Maples are at $590 over spot. Generic rounds are at $420 over spot. Think about what this means. Paper silver is trading at $33.24, but to actually buy physical silver, you're paying $38 to $40, depending on the product. That's a 15% to 20% premium for physical delivery. That's not normal market functioning. That's shortage pricing. And it's not just retail premiums. Wholesale 1,000-ounce bars are showing premiums of $1.10 to $1.50 over spot. These are institutional size bars that normally trade at $0.20 to $0.40 over spot. The premium tripling at the wholesale level tells you this isn't retail hype. This is genuine tightness through the entire supply chain. Delivery times have extended dramatically. Major dealers are quoting 4 to 5 weeks for products that normally ship in 3 to 5 days. Some products show limited availability or call for pricing, which is dealer code for "we don't have inventory, but we'll try to source it if you really want it." When dealers can't commit to pricing or delivery times, it means their supplier network is stressed. It means they're not confident they can source product at predictable prices. This is the early stage of a physical shortage that eventually forces paper prices higher to ration demand. Let me show you what's happening at the mints, because this confirms the physical stress. The U.S. Mint sold 1.8 million Silver Eagles in January. That's 42% above the 5-year January average. Demand is surging, but the Mint has already implemented allocation limits to dealers. When the Mint allocates, it means they can't keep up with demand even running at capacity. And here's the problem. The Mint can't just increase capacity. They have limited staff, limited equipment, limited planche supply. They're maxed out. So what happens when demand exceeds Mint capacity? Premiums rise, and they rise until demand is rationed back down to match available supply. We're in that process right now. Premiums are rising to slow demand, but demand keeps coming anyway. The Royal Canadian Mint is reporting similar stress. Perth Mint in Australia has wait lists for certain products. European mints are running 3 to 4 weeks behind on orders. This is a global phenomenon, not isolated to one region. Now look at what's happening in the COMEX delivery system, because this is where physical stress intersects with the paper market. February delivery month just completed. Total deliveries were 2,847 contracts. That's 14.2 million ounces delivered. But here's what's significant. Of that 14.2 million ounces, only 4.1 million came from registered inventory. The other 10.1 million ounces had to be transferred from eligible to registered before it could be delivered. That's a 71% reliance on eligible inventory to meet delivery demand. When the COMEX has to rely on eligible inventory to satisfy deliveries, it tells you registered inventory is insufficient, and eligible inventory isn't guaranteed to stay available. It can be withdrawn at any time by the owners. The registered inventory that's supposed to back the futures market is at critically low levels, and the market is becoming dependent on inventory that could disappear if owners decide to withdraw. Let me show you what's happening with industrial users, because this adds to the physical demand pressure. Solar panel manufacturers are forward buying silver at levels we haven't seen before. They're contracting for delivery 6 to 12 months out instead of the typical 3 to 4 months. Why? Because they're worried about supply availability. They're seeing the same stress signals in the market that we're discussing, and they're locking in supply now before the shortage gets worse. When industrial users who consume millions of ounces annually are forward buying aggressively, it removes supply from the market today to satisfy demand months from now. This accelerates the timeline to shortage. Electric vehicle manufacturers are doing the same thing. Battery production requires silver for connections and conductivity. EV production is ramping globally, and manufacturers are securing silver supply well in advance because they can't afford production stoppages due to material shortage. This industrial forward buying is invisible to most investors. It doesn't show up in spot price, it doesn't make headlines, but it's removing millions of ounces from available supply while the market looks calm. Now let me show you what China is doing, because this is the wild card that could trigger the breakout from this compression. China's export restrictions on silver went into effect March 1st. We're now in the enforcement phase. Initial reports suggest that export permit approvals are running 60 to 70% below typical volumes. That means 30-40% of China's normal silver exports are being held back. China exports roughly 3,800 tons annually. A 35% reduction is 1,330 tons, or about 42 million ounces. Removing 42 million ounces from global supply in a market already running a 118 million ounce deficit is catastrophic for the supply-demand balance. It means the deficit just widened to 160 million ounces. At that deficit rate, we have about 10 months before above-ground inventories are depleted to crisis levels. But here's what makes this critical for the current calm. The export restrictions are new. The market hasn't fully priced in the supply impact yet. When industrial users realize Chinese supply isn't available, they'll bid aggressively for supply from other sources. That bidding war is what breaks the calm and triggers the surge. The physical market is screaming shortage. Premiums spiking. Delivery times extending, mints allocating, COMEX drawing eligible inventory, industrial users forward buying, China restricting exports, all while paper price sits quietly in a tight range. This disconnect can't last. The calm you're seeing is the eye of the hurricane. Now let me show you the catalysts that could trigger the breakout from this calm and what the surge might look like when it happens. Because understanding the potential triggers helps you position before they occur rather than chasing after. The first catalyst is a dollar breakdown. The dollar index is sitting at 107.20, right at a critical support level that's held for 3 months. If that support breaks, the technical target is 103.50. That's a 3.4% decline in the dollar. Historically, a 3.4% dollar decline translates to approximately a 6% to 8% gain in silver, based on their inverse correlation. From 33.24, that would put silver at $35.25 to $35.80. That breakout above $34 resistance would confirm the surge has started. The timing on the dollar breakdown could be imminent. The dollar just posted an evening star reversal pattern on the daily chart. Volume on down days is increasing while volume on up days is declining. The MACD is showing bearish divergence, all signals pointing to a breakdown. The second catalyst is a continuation of the gold rally. Gold is at 2,815s, just $85 away from $3,000. When gold crosses major psychological levels like $3,000, it generates massive media attention. That attention spills over into silver as investors looking for leverage discover the gold to silver ratio. At 87.6 to 1, the gold to silver ratio is screaming that silver is undervalued. If gold hits $3,000 and the ratio compresses even modestly to 80 to 1, silver needs to be at $37.50. That's a 13% gain from current levels triggered purely by ratio reversion. The third catalyst is a COMEX delivery squeeze. March delivery month starts in 2 days. If we see standing for delivery significantly above recent averages, it could expose the inventory shortage and trigger a scramble for physical metal. Delivery demand has been running 35% above normal for the past 3 months. If that continues or accelerates in March, and if registered inventory continues declining, we could see a situation where the COMEX struggles to make deliveries. That would destroy confidence in the paper market and force prices higher. The fourth catalyst is an industrial buyer panic. If a major solar manufacturer or EV producer can't source silver at current prices and has to bid aggressively to secure supply, it could trigger a chain reaction. Other industrial users would realize supply is that tight and rush to lock in their own forward contracts. This kind of industrial buying panic happened in 2021 when solar demand surged unexpectedly. Silver rallied 22% in 6 weeks as industrial users competed for scarce supply. We're set up for a similar dynamic now. The fifth catalyst is renewed investment demand. Right now, investment demand is relatively muted. ETF holdings are flat. Retail buying is steady, but not surging. But if silver breaks above 34.50, it triggers technical buy signals that will attract momentum traders and trend followers. Once momentum buying starts, it creates a feedback loop. Rising prices attract more buyers. More buyers push prices higher. Media coverage increases. Retail FOMO kicks in. The surge feeds on itself. Now let me show you what the surge could look like based on historical patterns and current setup. When silver breaks out of compression patterns similar to what we have now, the initial move averages 8-12% over 10-15 trading days. From $33.24, an 8% move puts us at $35.90. A 12% move puts us at $37.23. That's the first leg. The breakout and immediate momentum phase. After the initial surge, there's typically a 3 to 5 day consolidation where early buyers take profits and weak hands shake out. Price might pull back 3 to 5% from the highs during this consolidation. This is normal and healthy. It sets up the second leg. The second leg is where the real money gets made. This is when the fundamental story catches up to the technical breakout. When media starts covering it, when retail FOMO kicks in. This leg typically lasts 4-8 weeks and can produce gains of 20-35% from the consolidation lows. If the consolidation after the first leg happens around $36 and the second leg produces a 25% gain, that puts silver at 45. That's a 35% gain from current levels over a 2 to 3 month time frame. But here's what could make this surge even larger. The fundamental deficit is worse now than it was during previous surges. The COMEX inventory is lower. Industrial demand is higher. China's export restrictions are new. The setup for a supply squeeze is better than 2020 or 2021. If we get a genuine physical squeeze that forces the paper market to reprice, we're not talking about 35% gains. We're talking about 50-80% gains. Silver at $50-60 becomes realistic if the squeeze dynamics play out. Let me show you the positioning strategy for the surge. Don't wait for the breakout to confirm. By the time it's obvious, the easy money is made. Position during the calm. Build your core position now while price is compressed and nobody cares. Use the compression boundaries as your guide. As long as silver holds above $32.50, the setup is intact. If it breaks below $32.50, the pattern fails and you exit. But as long as support holds, add to positions on any dips toward support. The breakout above $33.85 is your confirmation signal. When that happens, the surge has started. Don't chase aggressively after the breakout. Let the first leg run. Wait for the consolidation. Add to positions during the consolidation for the second leg. This is the calm before the powerful silver market surge. The compression is maximum. The catalysts are aligning. The fundamentals support explosive upside. And most importantly, nobody is positioned because the calm has lulled them to sleep. That's exactly what makes this opportunity so powerful.